Okay, good afternoon. I know it's just us standing between you and the end of the day. We'll try to get through this as quickly as we can. Hello, I'm Dwayne Abel. Pleased to be here this afternoon. I'm a Deputy Director in our Division of Registration and Inspections, and I also serve as a Program Leader for the NAF program. I'm pleased to present this session with Janet Borgman, who is an Associate Director from our Dallas office, Vic Rodriguez from our New York office, and he's also the firm coordinator for this region. We also have Ben Thompson, who will come up in a little bit. He's an associate director from our Dallas office and works with our remediation team. Before we begin, we want to provide the same general disclaimer. Seems like we should be able to do it once at the beginning of the day, but we each have to do it. The views we express are in our official capacity as members of DRI, but are our own and do not necessarily reflect the views of the board, any individual board members, or other members of the staff. During our session, we're going to focus on four different areas. First, I'll provide an update on DRI's inspections, including 2024 inspection results. Second, I'll get into a few insights in the way that we're working to improve audit quality. Janet will then do a deep dive into some illustrated examples on auditing revenue and related accounts. Then Vic will give you a deep dive illustration into some examples on auditing cash flow projections. And last but definitely not least, Ben will give you an overview of the remediation process as well as an illustrative example related to applying our remediation guidance. Okay, 2024 inspections. We're definitely well into our 2025 inspection cycle, but obviously we're still working on those results, and we look forward to providing those results once they become available. But looking back to 2024, excluding the BD inspections, we inspected 171 audit firms, reviewing portions over 800 public company audits. These inspections were carried out in 36 countries. Our inspection staff have a variety of backgrounds and represent over 30 different industries and sectors, and also we have expertise in over 30 different languages, which is important as we perform our work of improving audit quality across the globe. As Board Member Thompson noted earlier today, after several years of increasing deficiency rates, we saw noticeable improvements in aggregate deficiency rates across all categories of inspected firms in 2024. Let me share a few key statistics related to those inspections. For the U.S. G&F firms, which are obviously the large firms, the aggregate Part 1A deficiency rate for those 6 firms decreased from 34% in 2023 to 26% in 2024. For the NAF annually inspected firms, there are 8 firms that were in that category. Those rates decreased from 53% in 2023 to 52% in 2024. You think, well, maybe that's not that great of a result, but we did note that the types of deficiencies we identified narrowed in scope between those 2 years. And I will say that when we look across the annually inspected firms through our 2025 inspections, although it's still preliminary, we are continuing to see improvements in these results. For the triennially inspected firms, although the same firms are not inspected year over year, we did see improvements in both the U.S. and the non-U.S., both within the NAF and the GNF non-U.S. So the aggregate deficiency rates at NAF triennially inspected firms decreased from 67% in 2023 to 61% in 2024. And for the GNF non-U.S. firms, triennially inspected firms, the rates decreased from 35% in 2023 to 26% in 2024. Some of you have probably been inspected in the past, have interacted with our inspectors, and you know firsthand that we're focused on driving overall audit quality, not just through the reports and remediation process, but also through constructive dialogue about what we're seeing in the work papers. With these improved Part 1 deficiency result, it appears that all of the hard work that you all are doing at the firms to increase audit quality is actually bringing about positive changes and is now being reflected in those inspection activities. And now I'd like to turn to some areas of common audit findings. Now, in the interest of time, I'm not going to go through each of these areas like we have in prior small business forums, but what I'll do is I'll just talk about some broad categories of observations here. As you can see, that many of these areas would involve areas of significant estimates and judgments, and we definitely have findings relating to significant estimates. And later, when we get into the examples, we'll dive into some of those. But I would like to point out that there's some basic blocking and tackling type of deficiencies that we still are identifying. First, in the area of data and reports, we still come across no testing of data and reports that auditors are using, or very, very poor testing of those data and reports. We have situations where auditors did not test key disclosures relating to significant accounts, as well as no testing of key inputs or assumptions into significant estimates. Now, these are the, like I said, the basic would be you got to do some level of testing, but we still do find areas where there is no testing of important information. Okay, I think we are at a CPE code 731. You could add that in. Okay. I think we've had maybe 3 or 4 different times today where we've talked about some of the different publications that we have and things that are on our website. I'm going to go through some more of that. If you, by chance, have an upcoming inspection for the rest of this year and you want to understand what our inspection priorities are, each year we do have a spotlight relating to the upcoming inspection year. The spotlight on priorities for 2025 inspections was published in December of last year. So I encourage you to take a look at that. Interesting information in there, but I'm not going to take much time beyond what's there on the screen. So far today, we've highlighted a number of ways that we are working to drive improvements in audit quality, whether it's through the core inspection activities. We're trying to get our inspection reports out more quickly. We have the spotlight publications. We are exploring more and more ways that we can help smaller firms in looking at additional resources that might help smaller firms. If there are things that you are interested in, things that you would like to hear more about, spotlights or otherwise, please reach out to us after or send messages in. We're definitely looking for additional ideas on ways that we can help you. Both Janet and I are representatives with a small firm resource group, and we reach out to that group as well for ways that the smaller firms need, in what areas do you need help. And I should note that, when I say smaller firm, we look at firms that audit below 100 issuers. So that's generally within that smaller firm category. As Donna noted, we've been working to increase the usefulness and availability of information tailored to smaller firms. We have different web pages that are up on our website that are focused on smaller firms. We have the Audit Focus series, a lot of good information there. Topics that are covered in the Audit Focus series include things such as CAMs, Audit Committee communications, journal entries, Form AP, auditing estimates, and engagement acceptance. I encourage you to take a look through those documents. We've created a web page with videos and other resources tailored to non-U.S. firms. And we've also increased the number of these in-person small business and broker-dealer forums. And last, we are also trying to increase the awareness about our remediation activities. You know, remediation is clearly where the rubber meets the road as far as like improving a firm's system of quality control that's directly related to deficiencies that we find as inspectors. Ben will be providing some additional information later on remediation, like I said. Okay. I'm going to go through a couple of different slides here that just show some of the information that's available up on the website. Now, I tend to geek out when it comes to data and that kind of stuff, and so hopefully some of you will share that enthusiasm with me. But up on our website, we do have two different pages, and these are kind of superimposed on each other. One for the U.S. G&F firms, and it has a lot of information about the historical findings for the G&Fs. But we also have one for the non-affiliated firms, which are the annual firms. We are working on some additional information to provide for triennial. Hopefully that will be coming soon. But I'd like to just point your attention to these two different categories of information. But we'll go through a couple other slides here that'll just highlight what this information looks like. For both G&F as well as the NEF annuals, there are charts that show deficiency rates by firm. You can click on them and actually get more information once you get in there. I think it's really awesome to see a chart like this just to see what the trends are looking like. And we sincerely hope that we'll see all of these start to trend down, right, when we're talking about these Part 1 deficiency rates. Next. Here we have information about Part 1B deficiencies by area. Again, I encourage you to look at these and spend some time thinking about, you know, where we have been finding deficiencies. And I also note that as you go across the top, you can actually look at it by year. You can also look at it for the last 4 years combined, which is interesting. The next slide, this is deficiencies by auditing standard. Next one is, actually, if we could go back, sorry. If you look down at the very bottom, that's revenue and related accounts. You can see that that's an area that we look at a lot, you know, the biggest line on the screen. But you can also see the dark blue, that's the number of deficiencies, so that's where we find deficiencies the most as well. So as you are conducting your audits, I encourage you to stay keenly focused on revenue. Here's by issuer characteristics. Why don't we move on? And here's by audit, by tenure of the auditor. So we've sliced and diced up this data in different ways, which I think is really interesting. We can just flip through, but as you can see, there's a lot of information up there. Our next code word is 302, but I encourage you to spend some time on our website. Some great information there for you all. And with that, I'm going to turn it over to Janet to go through our first illustrative example.
Good afternoon. Okay, my name is Janet Borgman. I'm actually here in the Dallas office for PCAOB and worked in the non-affiliate firm program since 2006, so very familiar with the smaller firms. In this slide, Vic and I are going to go through some illustrated examples of these two specific financial statement areas in which we saw deficiencies in the 2024 non-affiliate firm inspections. And so those two areas are going to be auditing revenue and related accounts, and then the cash flow projections used in various estimates and impairments and business combinations. And then for each of these areas, we'll discuss the applicable PCAOB standards, common deficiencies found related to these areas in our 2024 inspections. So I'm going to cover the first area now, that's revenue and related accounts. And as Dwayne noted earlier, revenue continues to be our most common financial statement area with deficiencies identified in 2024. Therefore, revenue is frequently selected by us as a focus area, largely because it's a key metric in the company's public financial performance, and there's also complexities that are often associated with the revenue recognition policies and procedures, and then the auditing of those policies and procedures. So we have our first polling question here. Which PCAOB standard is applicable to the audit of revenue and related accounts? And I'll give you a minute to answer that. I don't think it's showing up. Might have to advance it. Do you have to advance it to give that answer?
Looks like the votes are still coming in, almost up to 60. It's still clipping in. We still have 82 people online. That's awesome.
Yeah,
Up to 90.
there we go. They're waking up.
Yeah. All right, looks like it's slowed down.
Okay, so the answer there is E, all of the above. So the graph here on the next slide kind of presents, here where we pulled from our PCAOB spotlight that summarized our 2024 inspection results. So this shows a reason, comment forms were issued in firm categories related to revenue and related accounts. The legend kind of shows descriptions can be mapped to the related auditing standards. And for example, more than 25% of the comment forms issued in revenue and related accounts are related to substantive procedures under AS 2301. And across all the firm categories, more than 20% of the comment forms issued are related to testing completeness and accuracy of data or audit evidence under AS 1105, paragraph 10. And then also across the firm categories, you can see that more than 5% of the comment forms issued are related to evaluating presentation and disclosures under AS 2810, paragraphs 30 and 31 in evaluating audit results. And while there's no specific PCAOB auditing standard for revenue, AS 2301, the auditor's responses to the risk of material misstatement is applicable, as the auditor should design and perform audit procedures in a manner that addresses the risk of material misstatement for each relevant assertion of significant accounts and disclosures. The auditor should, for significant risk, the auditor should also perform substantive procedures, including tests of details that are responsive to those risks that are identified. And then AS 2110, identifying and assessing risk of material misstatement, discusses the identification of significant risks and states that fraud risks are a significant risk. We've also observed a good number of deficiencies in the data and reports category, both in terms of testing completeness and accuracy of the data, as well as the relevance and reliability of audit evidence obtained as it relates to revenue. So the cited standards for these types of deficiencies was AS 1105. And AS 1105 is applicable to testing revenue in that the auditors must plan and perform audit procedures to obtain sufficient, appropriate audit evidence to provide a reasonable basis for the opinion. So sufficiency is the quantity of your audit evidence. Appropriateness would be the measure of the quality of that evidence, in other words, relevance and reliability. And relevance is going to refer to the relationship to the assertion or the objective of the control being tested. For example, information about company sales received via electronic data interface from an external source might not be relevant for testing the occurrence or allocation of revenue if the information lacks specific transaction data to make it possible to determine if the performance obligations have been satisfied. And then you've got reliability of audit evidence. That's going to depend on the nature and source of the evidence and the circumstances under which it's obtained. So for example, information generated by the company is more reliable when the company's controls over that information are effective. So under AS 1105, when using information produced by the company as audit evidence, the auditor should evaluate whether the information is sufficient and appropriate for purposes of performing your audit procedures. The auditor should test the accuracy and completeness of the information, or test controls over the accuracy and completion of the information. And also evaluate whether the information is sufficiently precise and detailed for purposes of the audit. So in April of 2024, we did put out a spotlight to highlight the inspection observations related to the auditor use of data and reports. And in this publication, we highlighted, recent staff observations on the use of information produced by the company, so referred to as IPC. And that information coming from external sources. So IPC is going to include company-produced information such as invoices issued by the company, shipping documents created by the company, that sort of thing. And the Spotlight publication also includes a discussion on common audit deficiencies, good practices, and other reminders that may help the auditors understand the testing of IPC and information from external sources, and to make sure it's properly performed. So that's a really good spotlight, and I would encourage you to kind of give that an informative read, because it's got a lot of good information in there on testing data and reports. The third most common and consistently identified deficiency in 2024 across all the firm categories was evaluating the presentation of financial statements and disclosures. So under AS 2810, in evaluating the presentation of the financial statements, including the disclosures, the auditors must evaluate whether the financial statements are presented fairly in all material respects in conformity with applicable financial reporting framework. And they should also evaluate whether the financial statements contain the information essential for a fair presentation of the financial statements in conformity with those applicable financial reporting framework. When evaluating whether the financial statements, including the notes, present fairly the financial position and results of operations and cash flows, the auditor should evaluate whether the financial statements and the information in the financial statements is presented and classified appropriately and in a manner that isn't misleading. They should also evaluate whether the accounting principles are appropriate in the circumstances, and also whether company transactions and relevant events and conditions are appropriately recognized, measured, and disclosed in the financial statements. So the evaluation of this information that's disclosed in the financial statements includes consideration of the form, arrangement, and content of the financial statements, including the notes, and encompassing certain matters such as terminology used, the amount of detail given, the classification of items in the financial statements, and then the basis of the amounts that are set forth in the financial statements. So our next slide, we're going to have another CPE code. So that code is 124. Again, that code is 124. Okay, and on the next slide, we've got another polling question. So, in your opinion, which element of auditing revenue and related accounts is the most challenging? And I'll give you a few minutes to respond to that. We've still got some votes coming in from, I think, our online group. Okay. I think we can advance it. Okay. Okay, so we've got quite a few responses there, but actually this is an opinion question, so there's no right answer on this. And the purpose of this is kind of to bring up the next illustrative examples of these deficiencies in revenue related to these challenging areas. These are some of the areas that are most challenging for auditors that we've seen deficiencies in. So to go through some of these, we're going to start with an illustrative example. So this is our first example related to these areas. So we've got some background facts here. The issuer is a seller of water products and with distributors, retail, and grocery stores as customers. The issuer's net sales are recorded net of sales discounts, allowances, and returns. And the issuer disclosed in its Form 10-K disclosure on significant accounting policies that the company recognizes as revenue the amount of the transaction price that is allocated to the respective performance obligation. When that performance obligation is satisfied, the company recognizes revenue upon completion of performance obligations or expiration of the contractual time to use services such as professional service hours purchased in bulk for a given period of time, known as the services. And in regard to the audit of this issuer, the engagement team's work papers included no evidence other than a statement that noted there was a revenue stream that included services, and the only revenue recognized was for the completion of performance obligations related to the delivery of products. So based on these facts presented, we've got another polling question. What potential deficiencies do you think were found? We've got no evidence in the work, we've got A, no evidence in the work papers that supports the disclosure. B, there's an error in the disclosure. C, the issuer does not have a service revenue stream. D, possible gap departures. Or E, no potential deficiencies. I'll give you a few minutes to respond there. So the responses are coming a little bit slower this time. So I think we'll advance and see what people are coming up with now while I kind of go over the. Okay. So the answers here are B, C, and D. So basically, in this example, the issuer sells water products to its customers, and it should recognize revenue at the time of the sale of these products and not as of a period of time. Therefore, deficiency was noted in the auditor's evaluation of the presentation of disclosures in accordance with the AS 2810, paragraphs 30 and 31. And that specific deficiency stated that the auditor did not identify and evaluate a gap departure related to the issuer's error in disclosures related to the service revenue stream that was not applicable to the issuer. And then continuing with this same example, in this slide I'm going to give some additional information on the procedures that were performed by the engagement team as it relates to the completeness and accuracy of reports. So in this particular fact pattern on the substantive test of revenue, the auditor tested the occurrence and completeness, accuracy, and disclosure assertions of the issuer's net sales by doing the following. They obtained an invoice listing from the issuer, which was filtered from a report downloaded from the issuer's general ledger. They traced 100% of the invoices generated in the invoice listing to the subsequent payments. And then they tested cutoff by selecting invoices from the invoice listing prior to and after year end and tracing those invoices back to packing slips, purchase orders, or remittance advices. And then their procedures to address disclosures, the auditor basically prepared a revenue disclosure checklist. So the next polling question is, based on these facts presented, did the auditor test or identify and test any controls over the completeness of the invoice listing from which it made its selections for the test of details on net sales? And I'll give you a minute or so here to respond to this question. So I think we'll advance the slide while I kind of go over the answer here. So looks like the majority of you got this one correct. The answer is no, B, no. So in this example, the auditor merely obtained the issuer's invoice listing, and they didn't perform any procedures to determine if all the information was complete and accurate. So the deficiency that was noted in this particular audit engagement was the auditor's testing of the accuracy and completeness of IPC in accordance with AS 1105, paragraph 10, was not accurate in that the auditor did not test or identify and test any controls over the completeness of the invoice listing from which it made its selections for the test of details on net sales. There's another polling question here related to this same example. So based on the facts presented, do you believe there are any other deficiencies? So A is no, B is yes, the auditor did not test the accuracy and completeness of sales discounts as the procedures were limited to testing sales on a net basis. Or C, yes, the auditor did not evaluate whether the performance obligation was completed. Or D, yes, B and C. Give you a few minutes to respond to that one. Okay, so we'll go ahead and advance the slide on this one. So it looks like most of you got this one correct too, with the answer being D. So in this situation, the auditor didn't perform sufficient substantive procedures in accordance with AS 2301, paragraphs 8 and 13. The particular deficiency noted here was that the auditor did not test the accuracy and completeness of sales discounts as the procedures were limited to testing sales on a net basis, and the auditor did not evaluate whether the performance obligation was completed. So our next slide, we've got another code word, CPE code. So this code is 326. Again, that code word is 326. Okay, so we're going to move on to one other example here. This involves this around deficiencies related to sufficient substantive testing of revenue. So for this particular issuer being audited, here's the background on this one. So the issuer disclosed in its notes to the financial statements that it accounted for revenue from the construction of systems over time using input method based on costs incurred as it progresses towards satisfaction of the performance obligation, otherwise known as percentage completion method. The issuer prepared a system-generated revenue schedule to calculate its revenue earned using the POC method, and the POC revenue schedule contained the contract values, actual costs incurred to date, and estimated costs of completion for each contract. The issuer's revenue process was supported by 3 information systems. Now, in regard to the audit of this issuer, the engagement team identified a significant deficiency related to the design, implementation, and operating effectiveness of change management and privileged access information technology general controls in 2 of the issuer's 3 information systems. And therefore, the engagement team did not take a controls reliance approach in its substantive testing of revenue. In addition, the engagement team performed the following substantive tests of revenue. So the auditors selected a sample of the construction contracts to test as follows. They obtained the cost control sheets by job and compared the total cost for each selection to the percentage of completion schedule. And then for a sample of the materials costs incurred, they vouched the costs from the cost control sheets to the related vendor invoices and purchase orders, noting the consistency of the job number between the cost control sheets and purchase orders. And for a sample of the labor costs incurred, they vouched the hours from the cost control sheet to internally generated timesheets from the IT system and further to the payroll register, compared the rate per hour from the control cost sheets to the payroll register, and then they recalculated the applied overhead burden rate. So as it relates to this example, the next polling question is, based on the facts presented, what potential deficiencies do you think were found? We've got unwarranted reliance on ITGCs, possible gap departure, no evidence in the work papers that supports the disclosure, completeness and accuracy of reports, or no potential deficiencies. So I'll give you a minute to put your answer on that one. Okay, so we'll go ahead and advance the slide on this one. Okay, so most of you got that one correct. The answer is D, completeness and accuracy of the reports. So based on the procedures performed by the engagement team, the following deficiencies were identified. In regarding to testing the accuracy of the IPC in accordance with AS 1105, paragraph 10, the auditor didn't test or testing controls over the accuracy of the rate per hour information that was in the payroll register, which was used in the testing of labor costs. And in addition, the engagement team failed to perform sufficient substantive procedures in accordance with AS 2301, paragraphs 8 and 13. So specifically, the auditors didn't sufficiently test the allocation of labor costs, as their procedures were limited to vouching the hours to internally generated timesheets without considering whether such costs were appropriately allocated to the relevant contracts. And the auditors didn't sufficiently test the allocation of material costs incurred, as the auditor's procedures were limited to vouching the costs to vendors' invoices and issuers' purchase orders without determining whether such costs were allocated to the relevant contracts. So now in regards to auditing revenue and related accounts, I want to go over some good practices. These good practices could be procedures, techniques, methodology, that's appropriately comprehensive and suitably designed in relation to the audit firm's size and the nature and complexity of the audit firm's practice that can contribute to good quality audit services. So to audit revenue effectively, the auditors should understand, among other things, the company's key products and services and their business processes that affect revenue. PCAOB standards require that as part of identifying significant accounts and disclosures and the relevant assertions, the auditors need to determine the likely sources of potential misstatements that could cause financial statements to be materially misstated. And as different types of revenues may have different likely sources of potential misstatements, disaggregating the product and the service revenue into similar revenue recognition streams, so in other words, like revenues at a point in time, overtime, single element, multiple elements, variable pricing, that sort of thing. And then further disaggregating these revenue streams based on the system of record or accounting locations. And if significant to the process, the control owner can assist with the auditor's identification and assessment of the risk and the development of these appropriate audit responses. And as the assessed risk of material misstatement increases, the evidence from these substantive procedures that the auditor should obtain to test revenue is also going to increase. The evidence produced by the auditor's substantive procedures depend upon the mix of the nature, timing, and extent of their procedures. And further, for an individual assertion, different combinations of the nature, timing, and extent of testing might provide sufficient appropriate audit evidence to respond to the assessed risk of a material misstatement. Also, when using IPC to select samples for testing, the auditor should test the completeness of or test controls over the completeness of such information. When using IPC as audit evidence, the auditor should evaluate whether the information is sufficient and appropriate for purposes of the audit by performing procedures over that IPC to test the accuracy and completeness of the information or test controls over the completeness and accuracy of that information. Evaluate whether the information is sufficiently precise and detailed for the purpose of your audit procedures. And a few more good practices focus on firm-developed templates to assist engagement teams, and some examples we've seen of that include firm risk assessment templates to help the engagement teams better capture and clearly document their linkage between likely sources of potential misstatements and controls to be tested, including data and IPC data and reports used as evidence, and firm templates for testing estimates, such as templates that map individual assumptions and inputs related to risks for the firm's controls and substantive testing approach. So that covers revenue and related accounts, and now Vic is going to take you through our next financial statement topic, which is cash flow projections.
Okay, and before I start, I just want to apologize for my voice. I'll try to speak clearly so you can understand me. So thank you, Janet, for those illustrative examples and certain challenging elements for auditing revenue and related accounts. I'll now take you through some considerations for auditing cash flow projections. Cash flow projections are one of many inputs to developing valuations and estimates and fall under AS 2501, auditing accounting estimates, including fair value measurements, and AS 1105, audit evidence. For AS 2501, what are the key aspects of the estimate standards that pertain to cash flow projections? Well, at a high level, 1, focuses auditors on estimates with greater risk of material misstatement through explicit integration of the requirements of the standard with the PCAOB's risk assessment standard. 2, emphasizes the application of professional skepticism, including addressing potential management bias. This is important given the subjective nature of accounting estimates that incorporate cash flow projections as an input to the estimate. Projected cash flows can include both historical data as well as assumptions such as discount rates and revenue projections. Another key aspect is that it includes 3 approaches to substantively testing estimates. And finally, the standard provides specific direction on auditing fair value financial instruments, particularly when pricing information is obtained from third parties. Given the short amount of time that we have allocated for today, I will not be covering this particular guidance. In auditing cash flow projections included in estimates, please keep in mind the requirements in the following auditing standards: AS 1105, audit evidence; AS 1201, Appendix C, supervision of the work of auditor-employed specialist; and AS 1210, using the work of an auditor-engaged specialist. In testing estimates that include cash flow projections, auditors frequently use the work of specialists as audit evidence. Okay, as I just mentioned, one of the key aspects is that there are 3 approaches to testing estimates, and an auditor may use any of the 3 approaches individually or in combination, which include 1, testing the company's process; 2, developing an independent expectation; or 3, evaluating audit evidence from subsequent events or transactions. However, the auditor's decision about the approach he or she takes to auditing projected cash flows as part of developing an estimate should necessarily be informed by the auditor's understanding of the process the company used to develop its estimate, and, if relevant controls are tested, the results of those tests. So what are some of the things auditors should think about when selecting a substantive approach or approaches? Well, there is no one-size-fits-all approach. How an auditor determines which approach or approaches to use will be informed by several things, such as the fact that cash flow projections can be affected by assumptions relating to the expected duration of the cash flows or projected revenue growth. Also, in a business combination, cash flow projections can be affected by assumptions related to discount rates, or whether there are additional separately identifiable intangible assets from which cash flows could be derived. The auditor should also consider the future cash flows to be obtained from assets acquired, such as licenses, patents, or trademarks. Another consideration is if the estimate has multiple components or multiple significant assumptions that affect projected cash flows, the auditor may want to use different approaches for individual components or for individual significant assumptions. And of course, if there are relevant subsequent events or transactions that occur, evaluating those events and transactions may be your best bet at testing for the testing approach. Okay, so let's walk through the requirements when the auditor tests the company's process, which is started by evaluating the company's method. The methods a company uses to develop an accounting estimate that includes cash flow projections and the corresponding inputs will typically depend on the nature of the estimate. For some cash flow projections, the method may involve the use of a model or another valuation method and may be driven by such things as revenue growth or expense projections. For other types of estimates, the method might be a calculation based on historical trends and other relevant data. The auditor is required to evaluate whether the method is in conformity with the requirements of the applicable financial framework. This includes whether the data is appropriately used and significant assumptions are appropriately applied, and whether the method is appropriate for the nature of the related account or disclosure, taking into account the auditor's understanding of the company and its environment. As you know, in some cases, financial reporting frameworks may prescribe a specific method to develop an estimate. In other instances, the frameworks may allow for alternative methods or may provide guidance on how to apply a method, including the selection or use of assumptions or data. It's important to keep in mind that the nature and extent of audit procedures to evaluate the method used by the company depend on a risk of material misstatement associated with the estimate and cash flow projections as an input. And this may vary with the type of estimate or the process used to develop the estimate. All right, so let's turn our attention towards data. The nature and extent of procedures to be performed with respect to data depend on whether the data is produced by the company or from external sources. Generally speaking, the requirements in this area align with existing requirements in AS 1105, the evidence standard. For data produced by the company, auditors are required to test the accuracy and completeness of the information or controls over the accuracy and completeness and evaluate whether it's sufficiently precise for purposes of audit. For data from external sources, the auditor should evaluate the relevance and reliability of data. So we talked about methods and data. And now I want to focus a bit on the main part of developing an estimate, the assumptions used that are specific to cash flow projections. So for assumptions, there are two aspects of the AS 2501 requirements. First, the auditor is required to identify the significant assumptions used by the company. And you do that by taking into account the nature of the estimate, including related risk factors, the requirements of the applicable financial reporting framework, and the auditor's understanding of the company's process for developing cash flow projections as an input to the estimate. Said another way, auditors are using the knowledge they've gained from the risk assessment process and other procedures to help identify significant assumptions used in cash flow projections. So what are significant assumptions? They are assumptions that are important to the recognition or measurement of the accounting estimate in the financial statements. The standard provides examples of assumptions that ordinarily would be considered significant assumptions, including those that are sensitive to variation, such that minor changes in the assumptions can cause significant changes to the estimate, are susceptible to manipulation or bias, involve unobservable data or company adjustments of observable data, or depend on the company's intent and ability to carry out specific courses of action. What I want to point out here is that the examples in the standard are not intended to be an exhaustive list of all the attributes of significant assumptions. Facts and circumstances come into play. In addition, the requirements for documenting the significant assumptions identified by the auditor are not new. AS 1215 sets forth requirements for audit documentation, including a requirement that it contains sufficient information to enable an experienced auditor to understand the nature, timing, extent, and the results of procedures performed, evidence obtained, and conclusions reached. Consistent with the standard, auditors should document the significant assumptions they identified and the rationale for that determination. The auditor is not, however, expected to document a detailed comparison of each assumption to the examples of the significant assumptions I just described that could be used in the cash flow projections as an input to the development of the estimate. The second aspect for assumptions in AS 2501 is that once the auditor has identified these significant assumptions, the auditor is then required to evaluate them for reasonableness, both individually and in combination. So let's talk about this aspect. Evaluating reasonableness of the significant assumptions, of which there are several requirements. The auditor should evaluate whether the company has a reasonable basis for significant assumptions. Recognizing what constitutes a reasonable basis will vary depending on the assumption. So, for example, a reasonable basis for revenue growth projections as an input to projected cash flows would differ from the basis for historical growth. Some assumptions might be supported by detailed calculations or historical information specific to the company, while other assumptions might be based on industry data. Here, the auditor thinks about whether the assumption is based on analysis of relevant information or determined arbitrarily with little or no analysis. Okay, next code number is 111. It's 111. Okay. As previously mentioned, another approach for testing estimates is for the auditor to develop an independent expectation. This approach involves the auditor using some or all their own methods, data, and assumptions to develop an expectation of the estimate and compare the expectation with the company's estimate. Similar to when testing the company's process, the auditor should take into account the requirements of the applicable financial reporting framework and the auditor's understanding of the company's process, including the significant assumptions used by the company, so the auditor's expectations considers the factors relevant to the estimate. You'll see a lot of similarities here in the requirements for the auditor when using this particular approach. The auditor needs to have a reasonable basis for the assumption and method used in developing the cash flow projections. It's important to evaluate the relevance and reliability of the data or assumptions used in the cash flow projections obtained from a third party. The auditor should test the accuracy and completeness of the data produced by the company. They also need to evaluate the reasonableness of the significant assumptions used in the cash flow projections that were developed by the company, as well as evaluate the appropriateness of the company's methods in developing the cash flow projections. With regards to the third approach, when the auditor obtains audit evidence from the events or transactions that occur after the measurement date, they should evaluate whether the audit evidence is sufficient, reliable, and relevant to the accounting estimate, and whether the evidence supports or contradicts the company's cash flow projection estimate. They should also take into account changes in the company's circumstances and other relevant conditions between the event or transaction date and the measurement date. This next section goes through two different exercises, and the first one is related to the valuation of goodwill. So I'll just read through the fact pattern here. The issuer used an external valuation specialist to perform its annual goodwill impairment analysis as of December 31st, 2020X. The specialist performed the analysis using the income approach. The discount rate developed by the specialist was based on the weighted average cost of capital using an adjusted beta and no additional risk adjustment factor. The auditor performed the following procedures to test the reasonableness of certain assumptions used by the specialist in a discounted cash flow analysis. For the revenue growth rate, the auditor traced the revenue for 2020X to the financial statements, compared the growth rate to the rate used in the prior year projections, and noted it was consistent. For the discount rate, the auditor performed procedures to evaluate the reasonableness of the discount rate, including evaluating the source used by the issuer specialist for certain components used to calculate the WACC, long-term bond rate, equity market rate premium, adjusted beta, tax rate, and cost of debt, and determined the source to be relevant and reliable. Okay, that brings us to a polling question. So based on the facts presented, what potential deficiencies do you think were found? A, testing the accuracy and completeness of IPC. B, evaluating the reasonableness of projected revenues. C, evaluating the work of specialists. D, evaluating the reasonableness of significant assumptions. Or E, no potential deficiencies. And select any of the deficiencies that you think exist. Okay, just give you a little time to respond to the polling question. Okay, gonna move on. Okay. Looks like it's somewhat even here. And the answers are B and D. Did not evaluate the reasonableness of 1, projected revenues, and 2, significant assumptions. In this example, the engagement team did not perform sufficient procedures to test the valuation of goodwill in accordance with AS 1105 and AS 2501. Specifically, the engagement team did not, 1, perform sufficient procedures to evaluate the reasonableness of projected revenues, including the 5-year period for which revenues were projected, because it limited its procedures to evaluating the consistency of the growth rate assumptions with the growth rate assumption used in the prior year impairment analysis. And 2, the engagement team did not perform sufficient procedures to evaluate the reasonableness of the discount rate because the engagement team did not evaluate the company's specialist conclusion that no additional risk adjustment factor was necessary. Okay, so here's another example that came across on an inspection related to an acquisition and the use of projected cash flows and significant assumptions. And the fact pattern here is a little long, so please try to stay with me. The issuer entered into an equity acquisition agreement with shareholders of Company A to acquire a 100% equity interest in Company A. The issuer recorded intangible assets of $4 million related to customer relationship, technology, and data. The fair value was determined using the following methods: customer relationship, multi-period excess earnings, income approach; technology, relief from royalty, income approach; and data, market approach. The issuer's Form 10-K disclosure stated that the judgments used to estimate the fair value assigned to assets acquired and liabilities assumed, the intangible asset life, as well as the significant assumptions, can materially impact the issuer's consolidated financial statements. Significant assumptions used for the models included, but not limited to, the WACC, forecasted operating cash flows, discount rates, attrition rate, royalty saving rate, and quoted price in the market. The issuer utilized the assistance of a third-party valuation specialist to determine the fair values as of the date of acquisition. The engagement team concurred with the significant assumptions identified by the issuer. The engagement team performed the following substantive procedures to address the risk related to the valuation of the acquired intangible assets. It obtained from the issuer the valuation report prepared by the issuer's specialist and the underlying Excel spreadsheet that included the forecasted operating cash flows, valuation models, and assumptions used in the measurement of acquired intangible assets. the valuation report stated that the value analysis has been performed based on set of financial projections and historical financial data provided by issuer management. The issuer specialist also made inquiries to management to obtain an understanding of the basis and assumptions of the projections. However, the specialist did not attempt to verify the assumptions adopted in the projections and did not perform any audit or due diligence procedures or otherwise try to verify the truth, accuracy, or reliability of the information provided. And the issuer specialist also stated the financial projections are a key driver for the valuation. The engagement team used an auditor-employed specialist to review the reasonableness of the evaluation report. The auditor-employed specialist copied data from each tab of the spreadsheet to a new tab, added its conclusion at the bottom of each tab, and then copied the same conclusion to a summary tab. No exceptions were identified when reviewing the historical data, comparable companies' future cash flow forecast, weighted average cost of capital, or the market data. The auditor-employed specialist included an overall conclusion that through analyzing the adequacy of the evaluation method adopted for client relationships, technology, and data, the relevant parameters have been confirmed and recalculation performed. No significant deficiencies were found. Okay, brings us to the polling question. So based on the fact patterns that were presented, what potential deficiencies do you think were found? A, testing the accuracy and completeness of IPC. B, evaluating the reasonableness of the WAC, discount rates, attrition rate, royalty savings rate, or quoted price. C, evaluating the work of specialists. D, evaluating the reasonableness of significant assumptions. E, no potential deficiencies. Okay, just give you a minute to answer that, and please select all that you think are correct. Okay, looks like it's slowing down. No. Any more?
Go ahead.
Yeah, I would advance.
Okay. So the answer to this one was actually A, B, C, and D. In this example, the engagement team did not perform sufficient procedures to test the fair value of the acquired intangibles in accordance with AS 1105, AS 1201, and AS 2501. And specifically, the engagement team did not, 1, test the accuracy and completeness of the issuer-produced data and evaluate the relevance and reliability of the data from external sources used by the issuer specialist to determine the fair value of the acquired intangible assets. 2, evaluate the reasonableness of the significant assumptions related to forecasted operating cash flows provided by the issuer's management and used by the issuer specialist to develop the fair value of the acquired intangible assets. 3, evaluate the reasonableness of the WAC, discount rates, attrition rate, royalty savings rate, or quoted price in the market developed by the issuer specialist. And 4, perform sufficient procedures to evaluate the work of the auditor-employed specialist and identify when the auditor-employed specialist work did not provide sufficient audit evidence as described in the deficiencies above, and perform additional procedures or require the specialist to perform additional procedures to address the issues. So, what are some of the key takeaways for cash flow projections which are frequently used in accounting estimates? First, when cash flow projections are an input into an accounting estimate, it's important to identify the significant assumptions used in cash flow projections such that the audit effort is focused on those assumptions that are important to the recognition or measurement of the estimate. Second, when the auditor is testing the estimate through the testing of the company's process, they need to address all applicable requirements in evaluating the reasonableness of assumptions affecting cash flow projections. included in AS 2501, paragraphs 16, 16A, and 17 as applicable. And finally, when an auditor chooses to develop an independent expectation to test the accounting estimate and is using independent assumptions and methods, the auditor must have a reasonable basis for the assumptions and methods used in cash flow projections. Okay, so before we move on, I have another CPE code. Code is 532. Give you a moment to record that, and then Ben will give you a brief overview of the remediation process, and he'll take you through an illustrative example related to applying remediation guidance.
That was nice of you to put my name tag up. I like that. Okay, so I've got how many minutes? Like 30 seconds, maybe?
No,
How much time do you guys think I have here? on
15 minutes. Negative.
-2 minutes. Well, I appreciate you guys being here. I'll try to keep this quick. Many of you guys have dealt with remediation. My name's Ben Thompson. I'm part of the remediation team. I may have worked with some of you guys. The first thing that we wanted to talk about was just a refresher on the staff guidance. Many of you are very familiar with the staff guidance, and in the staff guidance, we apply 5 criteria. The first criteria is change. Does the remedial step represent a change to the firm's system of quality control that was in effect for the time of the conduct that resulted in the QCC? The second is relevance. Is the remedial step responsive to the specific quality control criticism? Have you identified the root cause of the underlying deficiency? If it's unclear, has the firm performed an appropriate root cause analysis? Third, which is really important, is design. Is it designed individually or in combination with other actions to remediate the QCC? A little later, we'll get to just a couple of discussion of things we look for in the design of training and audit tools. Next is implementation. What extent was the remedial step put into operation by the close of the 12-month remediation period? And if not fully implemented, has the firm demonstrated an appropriate level of diligence and reasonable progress in addressing this criticism during the 12-month period? The last of the criteria is execution and effectiveness. Has the remedial step achieved or is it expected to achieve the proposed effect that it was designed to achieve? So that's a refresher. You guys may have seen that many times. I'd now like to go through a brief application of the staff guidance. For illustration, based on the examples that we discussed today, the firm received a testing revenue QCC, which related to substantive testing of revenue based on findings in 2 audits related to the testing of completeness and accuracy of data and not evaluating whether a performance obligation was completed. So in order to develop effective remedial actions, we've put on the screen various things that the firm should consider. First, you should understand the scope. One of the things that we do as a remediation team is we look at the audit standards that are included in Part 2, and you should also look at the specific underlying standards included in Part 1A. The second is that you should perform a root cause analysis to develop appropriately designed remedial actions. Obviously, understanding what caused the deficiencies is most important. Also, special consideration should be given or be taken for QCCs that have persisted in inspection reports for many years. So in our example, after a thoughtful root cause analysis, the firm determined that there was a gap, a training gap, in understanding how to evaluate performance obligations, if performance obligations are satisfied before revenue is recognized, and the firm's revenue audit program did not contain clear guidance or steps related to testing the completeness and accuracy of the data used in the substantive testing. So basically, once the firm did this, they determined, since there was a training gap, that they would conduct training and that they would issue a new audit tool. That they would issue a new audit tool for testing the completeness and accuracy of data, and that the training would also cover this new audit tool. The firm also determined that it would monitor all issuer audits to make sure they had completed the new template, and selected a sample of audits to perform a pre-issuance review to evaluate the execution of the procedures. You can turn to the next one.
Okay.
So when it comes to training, so the firm decided to conduct a training and issue a new audit tool. The inspection staff takes into consideration various items when it comes to evaluating the design of training programs. We look at the content and the delivery method of the training. We consider the background and the qualifications of the course instructors. We consider all of these things that you guys would probably know. Who is the target audience? We consider the extent to which the training is mandatory and related participation, including the firm's process for monitoring participation. And then finally, we consider post-training steps such as, was there a test to test the retention of the course material and monitor the execution of audit procedures based on the training, and whether the training qualified for CPE. Next, we consider various things when it comes to evaluating the design of audit tools. I won't go through everything that we consider. A lot of that's in the spotlight that we issued. But one of the things we look at is the audit tool mandatory? If the firm leaves it to the discretion of the professionals, whether it's used and it's not widely adopted, the inspection staff may not consider the action to be appropriately designed. We look at the review requirements of the audit tool, who was required to review it, what's the timing for the completion of the audit tool, is it done at planning, is it done at final, how is the audit tool designed to remediate the QCC, were expectations regarding the use of the tool communicated to firm professionals. We look at a few other things related to audit tools. Are there actions to reinforce the tool? So we said that the firm implemented training. Does the firm cover the training, cover the audit tool in the training? Next, we'd like to cover quickly just some key reminders that comes from our supplemental staff guidance. We issued the supplemental staff guidance in October of last year, and the first reminder is to take full advantage of the remediation period. We only consider actions taken by the date that the 12 months after the date of the final inspection report. This is what we refer to as the RPE, or the remediation period end. A firm should start early. The firm is usually aware of what the issues are, what the criticisms may be through written comment forms. Next, we'd like to remind firms to plan ahead in order to get the benefit of our feedback, inspection staff feedback. We're willing to provide feedback, and we believe that this serves the PCAOB statutory mission of investor protection, but in no sense, one of the things we like to stress is that we're not a collaborator or coach with respect to the firm's remedial efforts. The firm remains solely responsible for remedial actions taken for the content of the submission. And as you guys know, our staff can best provide feedback when a firm submits a well-developed draft plan during the remediation period. We also want to remind firms to consider implementing actions early enough that you may be able to monitor the operation and include evidence that they were effective in the submission. Another reminder that a lot of firms do not think about is whether certain quality control criticisms persist due to the influence of non-technical factors such as firm culture. Why don't you turn to the next slide?
Remediation resources.
What's that? Yeah, on remediation resources.
It's down there. It's there.
What's that?
It's up.
Oh, okay. Thank you. I can't see that far. Sorry about that. So I know I'm between you and leaving, so this is our last slide. You guys can clap if you'd like. This is remediation resources. This is hopefully the most important slide. We want to close with the list of resources we have on our website. We have the staff guidance, which we just discussed. We have the supplemental staff guidance that we issued last October, which talks about several of the items I just mentioned. We also have a really good spotlight that was issued in February of 2023 that includes a lot of helpful information on remediation and covers some of the things that we look for that I mentioned earlier related to training and audit tools. And last, the most important thing that I wanted to bring up, and many of you may have seen this before, is that we created a remediation response template. And through experience and feedback, we believe this template has been useful to firms that have used it, both small and larger firms. And the purpose of this template is to provide firms with a standard format to describe how each action taken addresses the QCCs and how it meets the 5 criteria. The response template, we include an Excel template where the firm can list all of their actions and map those to the QCCs and to the root causes. And then we also have a Word template, and in the Word template, it's in a table format where the firm can list each action and then list how in detail how each action addresses the 5 criteria. The template's available for use. We encourage its use, but it's not required. We also have reference now in the inspection report transmittal letters, a reference to this response template. So if you're interested in using this response template, please reach out to the inspection staff. Thank you for your time. Hopefully that was quick enough.